Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlotnik. Today it is my pleasure and a privilege to welcome Ryan Severino. Hi, Ryan.
Hey, Mike. How are you?
I'm doing great. How are you?
I am pretty great myself, actually. So thanks for asking. It's nice to be able to answer with that after everything we've been through over the last 16 months or so.
That's right. It's been a wild roller coaster ride. Call it the COVID ride. It's been a disaster and a fast recovery. So at least it feels like we're getting back to life, back to reality, hopefully.
I have enjoyed reclaiming my life over the last 2 months or so. So it's after the previous 14 months, it's been nice to start to feel normal again. Whatever normal is on the other side of this, I'm starting to feel more normal, which I take as a very positive sign.
Yeah, I share your sentiment and your happiness with the reopening. So could you tell folks a little bit about you? Where do you live? Family? As I call it, kids, cats, pets.
Yeah, sure. I live in New Jersey, probably about 20 miles or so west of Manhattan. I've lived in the New York area almost my entire life, except for when I was an exchange student in Japan in high school, and then undergrad, I lived away for most of that time, except for summers and breaks and things. I've been married for 17 years. My wife and I have been together for 23 years, so about half our lives.
Congratulations.
Thanks. I have 2 kids, 2 daughters, a 12-year-old and a 7-year-old, who are just a lot of fun, as challenging as it could be being a parent sometimes. And I think we are all very excited to be on the what feels like the other side of this, and starting to do more normal things. Kids in school, going to camp, being able to get out and about a little bit more. I think we're all eager to get past this and get back to whatever normal becomes.
Yeah, makes sense. I know the drill. I'm married for almost 22 years, and I have 4 kids and a cat. So it's been a journey. By the way, I forgot to introduce you. So Ryan is a chief economist at JLL, and also he is an adjunct professor at Columbia and NYU. So the distinguished professor in one world and chief economist in another one.
Yeah, it's nice to be in both worlds at the same time. It's a different perspective than people who only operate in one of those worlds exclusively.
Yeah, I think you're actually both. The people that say you either do or you teach. Doing both is a rare breed, so I think you fall into that category.
Yeah, it's nice to be able to explain to my students what the textbook says and then how it actually works in the real world, because those are not always the same thing.
That's right. So let's shift into some real interesting discussion. Let's talk a little bit about inflation and the interest rates and what's happening in that world. But let's start with inflation. There's been a lot of fear, concern about the accelerating inflation. And what do you think? What's happening out there? What are you seeing today?
So certainly today we're seeing inflationary pressures that are the highest that we've seen in decades, to be honest. And I think that makes sense given what we're seeing in the world. I think it's in some ways, and I don't mean this to make it sound unfortunate, but it's a byproduct of the fact that we arrived at a place faster than most people, especially business leaders, thought we would get if you went back 6, 9, 12 months ago. And what I mean by that is, not only did we develop the vaccines quicker than I think initial expectations were, they are much more efficacious than people thought they were going to be. And at least in the United States, for all of the faults that we had in distributing them, we are among the leaders, certainly in the developed world, of distributing and administering vaccines. And so the issue with that is the demand side of the economy came roaring back much faster than the supply side of the economy could. It's always easy to turn the supply side of the economy off. It's much harder to turn it back on, especially when, if you think about our modern integrated globalized economy and modern integrated global supply chains, a lot of other parts of the world that produce things that we use, they are lagging us in vaccination. And so it's it's a very high class problem to have, but it's much easier to turn demand back on once you start, like we were saying, you get vaccinated, you start going out to dinners again, out to have a drink with your friends, people are starting to travel, go on vacations. It's very easy to bring the demand side of the economy back online once you vaccinate the population. Getting the supply side of the economy to respond as quickly is impossible. And so that's really where we are right now, where demand is really escalating, supply is struggling to keep up, and we get these temporary, for the most part, temporary bottlenecks, and where there's just too much demand relative to supply, especially when you think about where prices were last year. We're calculating inflation off of very low prices from last year, and so it has an outsized impact. That said, I think we are headed for, even once we move through this, inflation that's a bit above what we've gotten used to over the last business cycle or so, the last 10, 12, 13 years. I think that feels more like an anomaly to me, something that we probably shouldn't have gotten used to, but maybe too many people did get used to a little too easily. The Fed struggling to generate 2% inflation and those kinds of things. But I don't think that we're not going to be partying like it's 1979 anytime soon. I think it would be it's hard to envision making the same kinds of mistakes in concert the way that we did in the 70s that led us to that kind of real damaging inflation, the way that we saw it in the 70s into the early 1980s.
Yeah, it's great commentary. So what I'm hearing is inflation will continue, but it's not going to get into hyperinflation. It's not going to get into double digits type of a scenario.
Unless things really go wrong from here on out, because the good news is the things that are causing the inflation spurt that we're seeing right now are temporary, right? Pent up demand on the part of consumers will not remain pent up forever. That, the dry powder that they have sitting on their balance sheets as excess savings, that's already getting spent. So that will start to go away. The issues that we're seeing on the supply side, hiring people, being able to reopen bars and restaurants and have enough flights and things like that, that's already starting to abate. And then even once you think about government stimulus programs, deficit funded fiscal stimulus is not likely to happen again. There's very likely to be some kind of tax offset, which should mitigate that. And interest rates are already going up. They're not going up, I think, at the rate that some people thought they would be early in the year, but we're almost certainly not at a juncture where interest rates are going to start to trend downward again in any meaningful fashion. And so those things that have really been driving demand relative to supply should abate over time. And this is where I think some commodity inputs like lumber are really instructive. Lumber's still expensive relative to prices from last year, but we've already seen peak lumber prices and prices are starting to come down. Same thing for other inputs to construction and development. We're already seeing prices start to back off. I think as we get through the balance of this year, as more countries get vaccinated, as more people go back to work, I think some of that will stick around longer, but generally I expect to see supply issues that we're dealing with right now become less onerous over time.
Yeah, great commentary. I've heard, again, being in real estate, I've heard this more than once, that the supply chain is sort of semi-broken, it's been broken or damaged, and it is like moving a train. It's really hard to get it going again. Pushing it initially, it's very painful, and that's sort of, we've experienced that. So it makes a ton of sense. The one thing I did observe on the interest rates, at least in the recent movement of the 10-year treasuries, it feels like it's retreated a little bit. It was really going up from kind of the depths of the COVID, keep going up and up and up. And then there was a slowdown to some degree. And again, the 10-year treasury is what the market dictates, not a Fed policy thing. That's at least, it's supposed to be not a manipulated rate, but more of a market-driven rate. So any thoughts, is this just the market, it's a temporary retreat, or the rates are more or less stabilized and we're no longer, because the rates signal inflation, right? The rates, in theory, the market is so large, it's the largest market in the world. The rates predict what's going to happen with inflation. Right now, the message is inflation is still going, but it's slowing down a little bit. Is that what you're seeing?
Yeah, I think if you look at what happened from where rates bottomed last year to we'll call it at least for now, the cyclical high or the recent high, 1.7 or so earlier in the year, February, March, it seemed like a lot of people were getting concerned about the inflation narrative. And I think as as more and more people have delved into this and studied it and thought about it, I'm not saying I'm exactly right on this, but I think some of the people who were most concerned about inflation earlier in the year have now backed off from the most dire prognostications about where inflation was going. I'll be honest with you, though, I'm surprised to have seen it retreat from 1.7 down below 1.5. And again, to your point, the interest rate is whatever the market says it is. I still think rates are headed higher over time because I think economic growth is going to be strong this year into next year. I think inflation, as I mentioned, is going to settle in probably at a level that's above what we've gotten used to, even if the kind of scorching inflation readings that we've seen, well, that's a little hyperbolic, but the high inflation readings that we've seen over the last couple months or so don't stick around. I think eventually people are going to reconcile those things and say, okay, this is not the 1970s, but this is also not, 2013, 14, 15, 16 either, that we're, somewhere in between. And I think that is a good realization that we don't always have to end up at extremes, that we don't have to end up in the 1970s, but we don't have to end up in the 2010s either. And we could still manage the economy really well in between those two extremes.
Yeah, great point. It's sort of the rates may revert to the mean, and the mean should be hopefully a little bit higher than the Fed target, 2.5, which has been a struggle, but now I know they were well above that level. Now,
and that's an interesting. Sorry, I was just going to say that's an interesting way to think about it, right? Because if you think about what the Fed's trying to signal with their forecast, the forward Fed funds rate should be the long-term interest rate, right? If they're projecting out 3, 4, 5 years down the road. So if they're saying they expect the Fed funds rate to get up to, just for argument's sake, 250 basis points, then it's reasonable to expect long-term bond rates like 10-year Treasury rate to eventually migrate up toward that over time. Whether or not that plays out remains to be seen, because we know last business cycle they had difficulty doing that, and we didn't have interest rates in the sort of 2.5 to 3% range for very long before the economy started to slow down and they backed off a little bit. But that I think is a good signal for most people to pay attention to. I think people sometimes forget that the forward Fed funds rate is intended or could be utilized as a bit of a guidepost to see where longer term rates are headed over time.
Yeah, great thoughts again. As much as you can believe that the Fed does all the right moves,
right.
I've seen they're always late. They're always late. They seem to use yesterday's data to plan today's moves, when in reality it should be the reverse. So
there's an interesting debate about how the Fed should be managing policy, and I think just going by what they've said, both in their notes and the statements and Chair Powell's testimony, it seems like they're taking a very show me attitude toward this right now, which is, we need to see exactly how this is unfolding before we're willing to make moves, as opposed to your point. The counter philosophy says, well, you should be anticipatory and make some changes in advance of those things. I think it's I'm not taking a stance on that. I'm simply saying the Fed it does seem like this time around, maybe because of, I don't want to speculate too much, but I think there was, at least in hindsight, some people were concerned that last cycle they raised rates too aggressively when the economy wasn't growing that quickly, when inflation wasn't that much of a concern. And it was one of the reasons why, even heading into the crisis, economic growth was slowing down. I don't know if the pendulum has swung too far in the other direction right now, but it does seem like they've learned from that. And the approach they're taking is, we want to see the actual data materialize first. And if we have to let inflation run hot for a little while, we are okay with that. And I think as long as they're clear and unambiguous about communicating that, I can live with that. And again, I'm not taking a stance on what they should or shouldn't do. I'm just saying, from my point of view, I just want them to be transparent and unambiguous, so I know how to think about it.
Yeah, makes total sense. They're certainly reactive than proactive. And is this a cardinal sin? No. They're letting low interest rates continue to fuel the economy. So from that perspective, It's not the worst thing in the world. But let's switch a little bit. I was reading an article yesterday where there is a prediction of a stock market crash. It was Michael Burry and Jeremy Grantham, effectively being being both big, I guess, doomsday theorists that the market is about this. We're about to see an epic stock market crash. Do you have any thoughts on this? Is this just some people like to put out extreme statements and kind of scare the world that this is coming? And I mean, are there real drivers other than very overvalued market based on PE expansion and based on the theory that a lot of money is just speculating in the market, that people are not investing, they're continuously speculating, they're paying any asset price, they're kind of using the momentum, it's moving in that direction, let's just keep buying, what else can we do with the money? So any commentary on are there big risks ahead that could severely impact the market?
So I'm always a little bit leery about making grand proclamations about stock market implosion, because those almost never come true unless you're consistently doing that, and eventually you're going to be right no matter what. But I think it's fair to say that valuations are high. If you look at any reasonable valuation metric like cyclically adjusted PE ratio, the only time that we've ever seen valuations higher was at the height of the dot-com bubble, and we know how that turned out. If you look at other similar points in time where the cyclically adjusted PE ratio was at similar levels, 1987 levels, 1929 levels, that didn't end so well. That said, I think we have to reconcile that against a couple things. The first thing is interest rates are still incredibly low by historical standards. So if you believe in valuation metrics, discounting future cash flows and things like that, then discount rates are pretty low these days. So valuations being high doesn't strike me as inordinate relative to the the interest rate environment. But the other thing I would say is a lot of the lofty valuation is being driven by a relatively small number of companies. I think the technology sector is really, and I'm far from the first person to say this, continues to take on an increasing outsized role. If you look at its percentage of the S&P 500 over time, and again, it's not even just the entirety of that industry. It's really a handful of companies. A lot of those companies have had a relatively free hand over the last, however far you want to go back, 10, 15, 20 to 30 years. They have quasi-monopoly power, which is why they've been so successful. I think the risk that I see, and this is hard to handicap, but if the regulatory environment changes, if antitrust policy and enforcement starts to change, that could potentially throw a wrench into that. But for now, it's really difficult to argue against these companies that are so dominant because they're effective monopolies. Antitrust is, I'm not a very political person, but just objectively, I think is not incredibly forceful right now. There's a lot of chatter about that, I think, across the political spectrum, but you're not seeing a lot of actual change there yet. That might be the one thing where I would say if that starts to change, if it moves from just being a conversation to actual enforcement changes, that would be something to keep an eye on. But for now, with those companies having quasi-monopoly power and interest rates still hovering at low levels, I think the valuations are rich, but I don't think they are dangerous the way that I thought it was with the heights of the dot-com bubble, where companies with no earnings were trading at such lofty valuations. A lot of these companies, it's the opposite problem. They have a lot of earnings, and I'd say in some respects, there's not enough competition in the market for them.
Yeah, that's a great point. The quasi-monopolies, they're dominating and they continue to dominate. And absolutely great point on the fact that in the post-COVID recovery, I think majority of the valuation increase has fallen on the small percentage of the market leaders. So that disparity, in theory, it needs to correct. It needs to shift some of this. Should be some rotation, but it hasn't happened because of that monopolistic power. So what this regulatory pressure would be almost like a black swan event if the regulators come in hard and heavy and try to put a lot of pressure. I was listening. A number of states are suing, I think, Google, and they're suing a few other these quasi monopolies because of the what has happened during the COVID and some of the manipulation that's happened. But that aside, you're not seeing anything major, right? The interest rates are staying low. By the way, the difference between these companies and the dot-com bubble, a lot of the dot-com companies were losing a lot of money, and the
Right.
valuations were through the roof. So that was very unsustainable. But these companies making a ton of money, it's just their PE ratios are in stratosphere. But that's been the norm because the growth of PE has been healthy.
Right. And I think that's what a lot of investors recognize, that it's not 2000, that they're not paying for negative earnings. Maybe you could argue that they're paying, that the earnings, that the effective price they're paying for these earnings is a little frothy, but at least, I'm not taking a stance on any of these companies, but if you think about, I won't name them, but the companies that I'm thinking about, they're making some pretty sizable earnings, these companies, especially
all the
when you
FANG
take into
companies are
account the
making
ones that are plowing the money back in, right? I mean, again, I won't name any names, but the company that I'm thinking of that takes a lot of the money it makes and just keeps plowing it back into the company. If they didn't do that, their earnings would look even better than they do now. And so I think that's where the question is what is the price that investors think these earnings are worth? And again, until I really see significant change in antitrust enforcement, I think investors are willing to pay a high premium for those companies because I think they recognize that they're quasi-monopolies, that they have these platforms that dampen competition, and they, it insulates them to a certain extent, gives them a bit of a moat around their business. It's been hard to compete that away. Classic, this is what we were saying before, there's a difference between textbook economics and classic economics. Textbook economics would say, okay, when these companies are generating, economic rents, basically just, making money above what a competitive, sort of discount rate says that they should be able to make, somebody should come in and compete that away. But the platform effects make it really hard to do that. So I think that's the question. Are the price that investors are paying for the earnings, is it appropriate? For right now, it's hard to argue that it isn't, given the regulatory environment. But ask me again after that changes, and I would probably have a somewhat different answer for you.
Yeah, great thoughts. The barrier to entry is still very high. I mean, these are quasi-monopolies and almost impossible to break into the market. So unless regulators break them up, right. They got kind of free sailing ahead. But let's switch a little bit and talk about housing market. So housing market has been hot, has been on fire. It's been surprisingly on fire. Obviously impacted by the supply chain type of environment. We've had lack of inventories for a long time, and competitive bidding wars, people overpaying without any consideration for fair market value. What is fair market value? It's what highest bid wins, right? So this continues to be the trend, and I personally worry about the trend continuing and affordability becoming an issue, because the growth, the income growth, is not keeping up with these price growths. It's sort of a stagflation environment. The prices keep going up, the salaries are not. How people can afford higher and higher prices, it's unclear. It's more of a they'll just pay a higher price because they want a house, they want to live somewhere, regardless of what are the economic consequences. So any thoughts on that? Is that going to slow down? I think the damaged supply chain is hurting the new supply coming into the play. I've heard conversations where people built, but they can't get appliances, they can't get some final finishes, so they're sitting on 90% done product, they can't deliver it, right? So
I'm laughing at that because almost literally across the street from me, catty corner to where I live, across the street 2 houses down, they are now knocking down a house that they bought in, not even recently, so in January, because I guess they've been going through permits and approvals for the last 6 months, because the price would be even higher today. They bought it in January for about $600,000 to knock it down so that they could put up a house they'll probably sell for, I don't know, $1.5 million ballpark, something like that. The big problem is that we continue to be chronically undersupplied on housing, especially I'm going to call it affordable, but when I say affordable, I don't explicitly mean rent controlled or rent stabilized. I mean anything that's reasonably affordable to someone who's trying to break into the market. And a big part of the problem is that we not only do we not build enough, but we don't build enough I'm using the term a little bit liberally, deem affordable, houses that are 1,400 square feet or less, something like that, because it's not the highest and best use of the land when you're already paying a pretty lofty land cost. And so I see this as a consequence of the fact that supply is just simply not keeping up with demand based on demographic change. Just looking at demographic changes alone, we should probably have 2 to 3 million more housing units in the United States than we have right now. And the fact that we don't is now manifesting itself in prices. And to be fair, prices were going up before this, but I think what this crisis did is it basically took anybody who was on the fence about buying a house and it pushed them off the fence onto the side of the fence that says we should go buy something. I think there were a number of people, especially people late 20s, early 30s, who were probably married, maybe didn't have kids or only had young children, who were equivocating about this. They were thinking, well, we've been renters, we haven't been homeowners just yet. They've been biding their time thinking about this. And then all of a sudden the pandemic hits, and then a premium on your own space really became important in a way that I think to a lot of people, it wasn't as important before this, right? The idea of sharing lobbies and elevators and living in dense urban areas, not as palatable during a pandemic as it is during non-pandemic times. And I think all of a sudden there were a lot of people who were living in the Manhattans and Brooklyns and San Franciscos and the Bostons of the world said, you know what, maybe this is the indication to us that we need to shift gears a little bit. And I just think the supply wasn't there for that. And I think that was, to an extent, that was, I think, a mistake that a lot of people in what I'll broadly call the residential market made. Because if you go back a decade or so ago, remember the big concern was about, we kept stereotyping millennials, right? Oh, millennials, they're never going to own anything, including their dwelling, and they're going to live in small apartments that they rent in urban areas, taking their bicycles and or public transportation to their green open plan offices where they're going to, I don't know, hold hands and sing Kumbaya and be really productive, that sort of thing. That was never true. And the thing that people missed on that was that people kind of got stuck in place last cycle because the housing market was the epicenter of the downturn. It was really hard to get a mortgage initially coming out of the recession. People kind of got stuck in place for a while. People were not really willing to sell their houses because prices were down. But around the middle of the last decade, that started to change very quietly. And then I think the market just didn't respond to that. The market kept believing this narrative that millennials were different, that they were not going to move to the suburbs and become homeowners and care about school systems and things like that. And that was never true. And it went from being this thing that flew under the radar to all of a sudden people realized, oh, that was a colossal mistake. And I think the fact that, to your point, people are just buying up anything because they want to have something, they want to have an entry point. And so I don't think the price increases that we've seen over the last year are sustainable. But that said, this is not the housing bubble of 2006, 2007, 2008, where people were lying on their mortgage applications to buy houses that they can't afford. If anything, what's happening is that people can afford these houses, so they're pricing people out of the market, which is why in what I'll call, good towns with good school systems, entry-level Cape Cods, 1,500 square feet are going for $500,000, $700,000, because there's, the people who would normally buy a reasonable $700,000 colonial or something like that are getting priced out. So they're having to buy the $500,000 square, the entry-level Cape Cod. And the people who would buy that entry-level Cape Cod have nowhere to go in those towns.
Yeah, great comment. It's a substitution effect as affordability is getting worse. People are substituting to a smaller product, but they still want a product, and
that's exactly right.
Yeah, so it's a bizarre world, and that's why affordable housing overall, and I too define affordable housing is not your subsidized housing. It's very different. We actually invest quite a bit in the hotel conversions to affordable multifamily, and that's a very different ball game. Affordable just means kind of below the average rent in a given area. So it depends on the area. if you're in an expensive area, that average rent is a lot higher than if it's a workforce housing. So just a few more questions. We're almost out of time, but
Sure.
just a final thoughts. So stimulus, what do you think about, is this sustainable, or we're running out of kind of the will and the way to keep throwing massive stimulus forward? Sort of the pandemic is somewhat under control. It's not perfect, but it's in a much better shape. So do you think the government is likely going to continue to make substantial investments, or at this point there's just not enough will to keep writing these outsized checks, not supported by anything but by pure borrowing?
Yeah, I think it's going to be hard from this point forward to make the argument that we need deficit finance stimulus, just objectively, given how strong the economy is right now. And I think you've already seen some pushback from that in Washington, not just from, again, not to be political, but not just from the Republican Party, but even some elements of the Democrat Party are saying, well, do we really need more deficit financing? Which is why I think you've seen some of the proposals that the administration is trying to get through have been more of a challenge, and they've had to sort of meet people closer to the idea that these need to be funded through some kind of revenue change, as opposed to just going out to the market. That said, we are still far enough below the threshold that I don't worry about the debt balances being a structural problem yet. But clearly, we can't keep borrowing like this ad infinitum. And the thing that concerns me is that the amounts that we keep borrowing, even relative to the size of the economy, keep going up over time. We never really fully backed off of what we did with the financial crisis, which was greater than what we did, in either of the two or three previous downturns. And this was clearly of an order of magnitude greater than anything we'd seen before, even the measures that were put in place for the financial crisis. And so my concern is that we can't play this game forever. We can play it for a little while longer. I don't think that the world is imploding tomorrow, but I think it's clearly how well the economy's responded over the last year makes it harder to argue that we need deficit finance stimulus, which is why I think whatever still comes out of Washington, whether it's infrastructure or something like that, is very likely going to have at least I think a decent portion of it backed by some kind of revenue change, because I think the appetite for purely deficit finance spending is diminished relative to what it was like in 2000 or even in early 2001.
Yeah, great point. You're almost on the point, and I thought about this issue before on the financial crisis, that we're doing package about 800 billion, and now during COVID, I think we spent about 10 times that, a trillion, something like that. So but what do you think about the following? So is the debt to GDP ratio are growing concern? Because basically we're borrowing a lot of money relative to the total size of the GDP and total national debt. And is GDP growing anywhere close to the way the debt is growing? It's not. At least it's not projected to grow that fast. So the debt growth relative to the GDP is a little bit alarming to me. What do you think?
Right. So this is where I think it depends on your time frame. I'm not so worried about this blowing up tomorrow, but you're right. With debt growing faster than GDP, this is not sustainable. I think the target on this admittedly keeps moving, but I think based on the most recent research, we're far enough below the gross debt to GDP threshold that I'm not worried about it tomorrow. But what I do think is concerning me are two things. Number one, like I was saying, we've been borrowing a lot more over the last 10, 12, 13 years than I remember being as a kid in the 80s, people were freaking out. That's a technical economics term, by the way, freaking out. People were freaking out about the amounts that we were borrowing back then. And that's nothing compared to what we've done over the last 10 to 12 years. So I'm concerned that the amounts keep going up. And what that means to me is I think it pulls the timeline to be concerned forward. How far, I'm not sure, maybe about 5 years forward. So maybe this is more of we have 15-ish years to think about this as opposed to 20. But what concerns me about it is that we are doing that against a backdrop that is generally not conducive, meaning we have a very significant structural demographic change in the United States with the baby boomers getting older, aging out of the workforce, increasingly drawing on the system, which means the number of people paying into the system is going down relative to the number of people who are going to be drawing on the system. That's what concerns me about this. That if we had a younger demographic profile, I'd be less concerned about it. Not just because I think economic growth would be faster, but again, the people drawing on the system relative to the people contributing to the system, we'd be in a different ratio than we're going to be over the next 15 to 20 years. That's why I think that this is not tenable in the long run, that the amounts that we're borrowing cannot be sustained relative to our demographic profile. And that's just, I just don't see our demographic profile changing that dramatically in that short a period of time.
Great point, and I'll just pivot. We're a little bit over time, but it's such a great discussion. Let's just take just a couple more minutes.
Sure.
So this number of worker bees versus the retired bees, that ratio has changed structurally from 15 to 1 many years ago down to where we are now. Was it 3 to 1 or something like that? But are we moving towards Japan model? Because Japan essentially hit that problem. And they have no choice but to get the rates down into the negative territory. And are we likely going to be in that position with the aging population, not enough young people working, supporting the payments to the folks who are past the retirement age? And what is the solution if we wind up in that? It's just keep borrowing and keeping the rates very low into negative. Is this a real threat? Or it's just, we have a model. Japan is a model, which is not necessarily a great model.
So here's the answer to that question. And again, I don't mean this to sound political, but it's the honest answer to the question. It depends on demographics, which right now in the United States depends a lot on immigration policy. And I know I wish immigration policy were depoliticized, because you're right, that dependency ratio has gotten worse over time. Unfortunately, immigration policy's become a political football, and to me, it's more of an economic issue. The reason Japan is in, to a large extent, the trouble that they're in is because they have a challenging demographic profile. And I love Japan. I lived there as an exchange student for a while, but they don't have a very favorable view toward immigration. So with their birth rate falling below the replacement rate and not being incredibly favorable toward immigration, their population is starting to decline, which is a massive problem for economic growth and dependency ratios and things like that. I think the average person probably doesn't appreciate how important immigration has been to the United States outcompeting other developed, not just in terms of pure economic growth, but I could cite a whole bunch of metrics. Immigrants create businesses faster than domestic-born population does. They tend to work at a higher rate than the domestic-born population does. They commit fewer crimes than the domestic-born population does. We have benefited to such a large extent. And it's just a shame that this is now a political football that gets tossed around. We're not easily going to be able to raise the birth rate, which in the United States has also fallen below the replacement rate. So to me, the easiest solution to this, barring the political side of it, would be to have an open but reasonable immigration policy. Right now, we have 9.2 million open but unfilled jobs in the United States. I'm sure a good number of those could go to people who would love to come here and work hard the way immigrants have for the entirety of immigration in the history of what we think of as the United States. So I know that's politically incendiary. I know that's not an easy sell to people, but unless you can somehow incentivize people to start having more children, which is that's not the trend in developed nations over time, the easiest solution to that problem, barring the political side of it, would be to have a different immigration policy. But that is a political non-starter among certain parts of the population these days.
Yeah, great point. I'm an immigrant. I came here, I immigrated to the United States as a political refugee from the former Soviet Union. And I thought it was the greatest opportunity. It was the greatest country in the world I was coming to. I'm a U.S. citizen, U.S. patriot, and I completely support immigration as a way to supplement the declining birth rates. And also, as you said, immigrants do have often come with the attitude that they have to make it in this country. And they were, and nothing against U.S. citizens, but immigrants, generally speaking, They feel it's a great opportunity to come here, an opportunity to live here and to work here, and as a result, there is that attitude that spells into a little bit more of, you said, business startups, more just in general cultural and educational enhancement of the U.S. melting pot. The U.S. is a country of immigrants. So the moment we stop letting immigrants in, it's a concern. So we need to have immigrants. We probably need to have a better policy and more legalized immigration versus what's happening right now. Unfortunately, it's a little bit out of control without taking political sides. But with more legalized immigration, I think we will accelerate some economic growth.
Again, to me, this is the low hanging fruit. And again, I'm not saying that we shouldn't have an intelligent policy, porous borders and things like that. But I think especially, and again, I'm trying not to get too political about this, but especially in a world where I think, and this is true across the political spectrum, people are increasingly concerned about China. I'm not taking that stance per se. I'm simply saying in a world where Americans across the political spectrum, across the ideological spectrum are worried about the Chinese military, the Chinese economy, them exporting their political influence around the world, you should want to have a bigger population to be able to more readily compete with them. You should not want to be closing the doors and slowing down your population growth. If anything, that makes it harder to compete. And even just beyond that, I hate to think of this country, which has been such a beacon for immigrants throughout almost the entirety of its history, that once people get here, they just close the door on other people. Again, we have to have better policy about this. I agree. But the idea, the thing in my mind that has always set the United States apart has not been the size of our economy or the size of our military or, whatever trouble we make around the world sometimes, intentionally, unintentionally, otherwise. I think it's been the fact that we are really this nation of different people. And it just shows the benefits of being that kind of place, which is open door and welcoming and does give people, sort of that ability to say, hey, come here, work hard, start a company, work for an organization, however you want to approach it. That's not an opportunity that you're going to see in a lot of other places around the world. And I think it's been why the United States has been so successful vis-a-vis just about every other developed nation in the post-war era. I don't want to see us shut that off. I think it's counterproductive in both the short run and the long run.
Yeah, great final comments, Ryan. I very much appreciate your wisdom, your thoughts, your comments, and your support of a great immigration policy. I certainly support that. So, thank you again. How would folks get a hold of you if they wanted to invite you to be, I don't know, a lecturer or just reach out with any thoughts? Is there a good way to reach out?
For better or worse, I'm really easy to find. You could find me on LinkedIn and Twitter. I'm also easy to find if you just search for Ryan Severino JLL. I'm sure my contact information is certainly on the JLL website. But anyone should feel free to reach out. Honestly, I'm more than happy to help if I can.
Thank you kindly. Appreciate you very much, and enjoy the rest of your day.
Thanks, Mike. You too. Take care now.
Thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.